The myth of currency mitigation within investments. So investors often come to us and say, I want to mitigate currency risk completely by buying an investment that is denominated in a different currency. So let's say, for example, you expect the dollar to go down further and you want to get your money out of dollars and put it into euros or pounds or whatever. The understanding from most people is that by moving it into a fund within that currency, you're mitigating that currency risk completely, but it isn't true at all. Before I go into the fun part of it, which is more complex, I'm just going to explain how currency can impact cash, as this is really black and white. So if you look at the pound versus the euro, in 2008, £10,000 would have gotten you 15,200 euros. A year later in 2009, that same £10,000 would have only gotten you 10,400 euros. So that's a drop of 30% in 1 year. If you're relying on that income for retirement, and that's a significant decrease in spending power that you've got. The pound versus the dollar has had an even bigger swing, but over a longer period of time. So in 2007, £10,000 could have bought you $20,500 in income, versus in 2022, that same £10,000 would have only gotten you 11,200. So that is a difference of almost 50%. So over the long run it can have a significant impact, but when you're buying a fund you may not necessarily be eradicating this risk at all. But if I start with fixed income portfolios, so fixed income is bonds. Generally speaking, all of these portfolios are hedged, and the reason they're hedged is because people that are buying bonds, they want predictability, they want reliability of returns, and interest rates are the one thing that have the most impact on currencies as well as bond prices. So if you see years like 2022 where interest rates move significantly, that has a massive impact on both currency and bonds. So if you are buying something that is supposed to be stable, of course that isn't going to create stability at all. So hedging makes sense. But for equity portfolios and equity funds and ETFs, they're almost never hedged. And the reason they're not hedged is because hedging costs. So let's say, for example, you're a fund manager, you're buying equities all around the world, and you've got, for example, 15 different currencies that you need to hedge because you've got stocks that are listed in Japan, Canada, US, Europe, UK, wherever. Every single one of these needs to be hedged into the currency that you want to hedge that portfolio into. So it costs money, it's more complex, but then also, the reason it's not hedged is because over the long run, currency risk often evens itself out. But that is over the long run. Short term it can have a significant impact. And if you take a look at Q2 2025, the S&P 500, which is invested into 500 US stocks, all in US dollars, it was up 10.5% in 3 months. But if you bought the euro version, it was only up 1.7%. If you bought the pound version, it was up just over 4%, and these are both unhedged. So if you're looking at, for example, the news and you're seeing the S&P's at an all-time high, but the return you've seen isn't an all-time high, you could be scratching your head thinking, what's happened? Well, it's because the fund or the ETF that you hold isn't hedged at all. If you did buy the hedged version, and there are hedged versions available, but it's often not the chosen option, then you would have seen 10.5% return. So it really depends on the type of equity fund that you have bought. And if you are looking to hedge, it does reduce the options that you've got available, because out of 10, maybe only one of those options is hedged. So the option is there, but it does restrict what you can buy. And a really good example was that I reviewed a portfolio when I was living in the Middle East almost 10 years ago, and it was the year of the Brexit referendum. And as we all know, the pound versus the dollar completely tanked. But the S&P 500 that year had gone up significantly. And I was reviewing a portfolio that was set up by a different advisor, and they had only made a 1% return. And he said to me, the S&P is at an all-time high, what is happening, where is my money going? And he thought that the advisor was doing something wrong. And I said, no, the return is there, but you're not seeing it because your investment is set up in GBP. If we took all of this money out today and we converted it into dollars, you would see that return instantly. So a lot of times all you're doing is you're seeing the reporting currency in a different currency, but actually wherever you're spending the money, that's the most important thing. So it's generally just best to have the investment set up in the currency of where you're going to be spending the money. If that option isn't available, obviously you can go to the second best alternative, but if you do want to have more clarification on this, please reach out to us, because it can be quite difficult to understand. And the reason sometimes it's difficult is because currencies are a zero-sum game. Equities and bonds, you know, over the long run are going to go up, whereas currencies can go in both directions, so it's zero-sum. And when you're having the impact of currency as well as what you're invested into, it can make things a bit more complex. So if you want more clarification, please reach out and we can go through it with you.